Hi, I'm Sylvia of IFRSbox.com and I help people simplify IFRS, and therefore I have created two courses, IFRS in 1 day for gaining the fast intro into the world of international accounting and IFRS Kit for getting to professional level. If you want to learn IFRS quickly, then you're welcome to visit my site IFRSbox.com. In this video, we'll look at the differences in hedge accounting rules between IAS 39 and IFRS 9. But before we start, let me explain the essentials of hedge accounting. So what is hedging? From the accounting point of view, it is designating one or more instruments so that their change in fair value is an offset to the change in fair value or cash flows of a hedged item. For example, imagine your company that normally operates in US dollars. Recently, your company has decided to spread its business to Europe and made a sale of some goods to European customers for, let's say, 20 million euro. Invoice to EU customer is due after 9 months. However, your company is afraid that due to movements in foreign currency rate, it will get significantly less US dollars after 9 months, and therefore, it enters into offsetting foreign currency forward contract with bank to sell 20 million euro for some fixed rate after 9 months. This is a typical and very common example of a cash flow hedge. US producer faces foreign currency risk that might alter the amount of US dollars received after 9 months. A hedged item here is the receivable to European customer due in 9 months. A hedging instrument here is the foreign currency forward contract with bank. It is an offsetting instrument to the receivable. So when US producer incurs foreign currency loss on the receivable, it incurs foreign currency gain on the forward contract and vice versa. So what happens after 9 months? First of all, US producer gets paid 20 million euro from European customer, but at the same time, as there is a forward contract with the bank, US producer pays these 20 million euro to the bank and receives some predetermined amount in US dollars. Effectively, he fixed this exchange rate 9 months ago when he entered into foreign currency forward. Now, let's see how it looks like in our accounting records. When you don't apply hedge accounting, then you would recognize the full loss on your forward currency forward contract to profit or loss, some finance expenses account, and you would credit your liabilities from derivatives. Of course, when you have a gain on the forward contract, the entry would be to debit receivables from derivatives and credit profit or loss finance revenues. With application of a hedge accounting, you would apply accounting treatment for a cash flow hedge in this case, so you would debit effective portion of your hedge to other comprehensive income and remaining or ineffective portion to profit or loss or finance expenses. The credit side is still the same, liabilities from derivatives. So, here you can see that with hedge accounting, the impact of fair value changes of derivatives or any other hedging instrument on your profit or loss is significantly lower. In other words, profit or loss shows much smaller volatility with hedge accounting than without it. So now that we understand what the hedging is, why are there rules for hedge accounting and why do they change? First of all, with hedge accounting, you show that your company faces certain risks such as foreign currency risk, commodity price risk, or interest rate risk. Hedge accounting also shows that your company undertakes certain hedging strategies in order to mitigate those risks and how effective these strategies are. Until recently, standard IAS 39 was the only one who set the rules for hedge accounting, but IAS 39 was really strict and difficult to apply, so lots of companies managed certain hedging strategies, but due to very strict rules, they could not apply hedge accounting. Therefore, on 19 November 2013, IFRS 9 was amended and now there are new rules for hedge accounting. So now we have two standards setting the rules for hedge accounting, IAS 39 and IFRS 9. First, let's take a look what these two standards have in common. Both standards say that hedge accounting is optional and not mandatory. So if you perform some hedging strategies but don't want to apply hedge accounting, you don't need to. But if you do, then you must fulfill certain conditions. Also, both standards contain basically the same terminology such as hedged item, hedging instrument, hedge effectiveness, etc. Next, Both standards require documenting a hedge relationship, so if you want to apply hedge accounting, you should document your hedging strategy. Both IAS 39 and IFRS 9 arrange the hedge accounting for the same categories: fair value hedge, cash flow hedge, and net investment hedge. The mechanics of the hedge accounting is basically the same. Both IAS 39 and IFRS 9 require accounting for any hedge ineffectiveness in profit or loss. Well, there is an exception related to hedge of equity investment designated at fair value through other comprehensive income in line with IFRS 9. All hedge ineffectiveness is recognized to other comprehensive income in this case. Also, use of written options as hedging instruments is prohibited by both standards. So, as you can see, basics of hedge accounting has not changed that much. IFRS 9 just broadened the situation in which you can apply the hedge accounting. So let's take a look to the main differences in hedge accounting rules between these two standards. First of all, IFRS 9 widens the choices of hedging instruments. Under IAS 39, companies either use some derivative as a hedging instrument, or alternatively, they could also take non-derivative financial asset or liability in a hedge of foreign currency risk, and that's not much. IFRS 9 allows you to use broader range of hedging instruments, including derivatives or any non-derivative financial asset or liability measured at fair value through profit or loss. As an example, let's say you have large inventories of crude oil and you would like to hedge their fair value. Therefore, you can make investment into some fund with portfolio of commodity-linked instruments. Well, in line with IAS 39, you cannot apply hedge accounting, because in a fair value hedge you can use only some derivative as your hedging instrument. But in line with IFRS 9, you can apply hedge accounting because IFRS 9 allows designating also non-derivative financial instruments at fair value through profit or loss. So I assume your investment into the fund would meet this condition. Another change is that IFRS 9 allows more items to be hedged. Older IAS 39 allows hedging only a non-financial item in its entirety and not isolated risk component of it. IFRS 9 allows hedging only a risk component of a non-financial item if that component is separately identifiable and measurable. Just imagine an airline who buys jet fuel regularly, and there is a significant risk here because prices of jet fuel change due to inflation, crude oil price, foreign currency rates, and other. Now imagine that an airline decides to hedge only a movement in crude oil prices, so that's just one risk component, and in order to hedge it, airlines acquires commodity forward contract to buy crude oil. Under IAS 39, an airline is not able to account for this commodity forward contract as for hedge. The reason is that an airline hedge item is just one risk component of a non-financial asset, jet fuel, and IAS 39 allows hedging non-financial items only in its entirety. In line with IFRS 9, an airline can apply hedge accounting because IFRS 9 allows designating separate risk component of a non-financial item as a hedge item. Another big difference between IAS 39 and IFRS 9 lies in testing the hedge effectiveness. IAS 39 contains really strict rules for testing the hedge effectiveness. In line with this standard, you need to test hedge effectiveness both retrospectively and prospectively, and therefore you need to perform a number of calculations just for accounting purposes. A hedge is highly effective only if the offset is in the range of 80 to 125%. On the other hand, IFRS 9 requires testing prospectively, and it outlines more principle-based criteria with no specific numerical thresholds, such as existence of an economic relationship between the hedging instruments and hedge item, etc. Another area of differences is rebalancing, which means modifying the hedge by adjusting the hedge ratio for risk management purposes. Well, it's usually performed when the quantities of hedge instrument or hedged item change. In a similar situation, IAS 39 required terminating the current hedge relationship and starting the new one. In practical terms, you would have to start all over again, prepare a hedge documentation, assess its effectiveness, etc. While IFRS 9 makes it easier because it allows certain changes to the hedge relationship without necessity to terminate it and to start a new one. When it comes to discontinuing the hedge accounting, IAS 39 allows terminating the hedge accounting voluntarily. So if your company decides no longer to apply hedge accounting to the hedge, it's okay under IAS 39. However, IFRS 9 does not permit discontinuing the hedge accounting voluntarily. You can do it only in the situation when risk management objective changed, the hedge expired, or is no longer eligible. Finally, there's a number of other changes in hedge accounting introduced by IFRS 9, so let me just name a few of them. Less profit or loss volatility when using options and/or forwards. There are more alternatives for hedges of credit risk using credit derivatives. Option to account for own use contracts to buy or sell a non-financial item at fair value through profit or loss if it eliminates accounting mismatch is new in IFRS 9. So, this was a brief comparison of hedge accounting rules in IAS 39 and IFRS 9. If you want to take your IFRS knowledge a little deeper, check out a sample of IFRS in one day by signing up for email updates at ifrsbox.com. You'll also receive the ebook Top 7 IFRS Mistakes for free. Thanks for watching and have a nice day!